Hi, my name is Jordan Brooks. I am Senior Market Analyst with ALN Apartment Data, and this is the latest installment of our Takeaways series, where we go a little bit more in depth on our monthly newsletter. This month, the newsletter was about some dichotomy between price class performance in the national data and a couple items that I didn't really have the space to dig a little bit deeper on. One would be some positive examples of markets. The newsletter spent most of the time talking about individual markets on sort of the negative examples of markets that are struggling either from an absorption perspective or on the occupancy or rent growth fronts. So I wanted to spend a little bit of time here going through some of the positive examples that we've seen so far this year, which would be through the month of August for 2024. And starting first with absorption, so realized apartment demand, markets that have sort of been leaders nationally. Interestingly, all of the markets, again, because the newsletter was broken out by price class, I'm going to also break these out by price class. So all of the top performing markets in terms of net absorption when we adjust for size, and the way we do that at ALN is sort of a standard method. So we take the number of absorbed units as a percentage of the number of total units in either the market or in this case, the price class of the market. And so we get a sort of a percent that it takes account of different market sizes to sort of stabilize those. So in this case, around the country, in terms of markets that have had positive demand, talking about areas like Orlando, price class C and class D, Austin, also class C and class D, the San Francisco, Oakland area, Bay Area of California, class C, Columbus, Ohio, class C, and then a couple more markets out west, Denver and Phoenix, also both class C. So again, all of those top performers sort of in the workforce housing segment. And then in terms of occupancy, all of the markets that I'll list here are 94 to 97% average occupancy at the end of August, again, for these specific price classes. So just worth pointing that out in that these are the top markets and price classes in the country, and we don't get above 97%. And in fact, a market that made the top 10, which would be Los Angeles, is only 94%. So again, even these top performers in sort of a typical period, maybe 2017, 2019 type time frame, would not necessarily be ranked this high, and that just sort of is an indication of where we are on the occupancy front. So in general, these markets were again class C and class D price classes, generally not located in the Sun Belt and not markets that were sort of at the tip of the spear for new supply over the last few years. So we're talking about areas like Buffalo, Dayton, Ohio, Cleveland, Chicago, and then the Sun Belt markets that did crack sort of the top of the list nationally for occupancy, again, class C and class D specifically, are Sunbelt markets that have not really been your Charlottes, Austins, various Florida markets in terms of new supply over the last few years. So those would be Los Angeles, Orange County, and San Diego. So again, those markets, either price class C or price class D, an average occupancy between 94 and 97%. And then on the rent front, all these markets gained between 3 and 5% through August. Again, all of these leaders are either class C or class D. So you're noticing a pattern here. For the most part, in terms of the main performance metrics that we look at, absorption, occupancy, rent growth, it's the class C and class D segments that are outperforming this year. And again, that's generally to do with new supply pressure at the top of the market. So in terms of rent growth, Buffalo, Cleveland, Chicago, Boston, New York, Baltimore, Detroit, Washington, D.C. Again, all either class C or class D in terms of those rankings, 3 to 5% rent growth year to date. And you'll notice, a few of those markets there, Buffalo, Cleveland, Chicago, were also in the list in terms of high average occupancy, not a ton of new supply relative to other parts of the country. New York and DC in particular, they have had a decent amount of new supply, but have managed to capture some rent growth. And then again, Baltimore and Detroit, not exactly the tip of the spear for new supply. So that's sort of a through line there in terms of the markets that are doing pretty well on the rent front. And then in the article, we touched briefly on this, but it's generally the case that the Sun Belt markets are seeing more of a struggle across the 4 price classes, certainly in terms of occupancy and rent growth, whereas other parts of the country to the extent that they are having some struggles, it's generally concentrated in one or two price classes. So they're either still struggling in the workforce segments with maybe negative net absorption, net loss of leased units, household consolidation, or they're struggling at the top of the market where there's just new supply coming in faster than they can absorb units. But a lot of these Sunbelt markets are seeing still softness across the price classes. And there really wasn't space in the newsletter to get into why that is, but a big reason is simply new supply. So a lot of these Sunbelt markets that have been getting a lot of new supply for years on end at this point have gotten into a little bit of an unusual situation now where we're seeing a good bit of new supply come into the market in more outlying submarkets and submarkets with lower average effective rents than maybe the average market rent. And so you're getting new supply coming into these lower rent areas that's still at the top of that submarket. But because ALN calculates price class at the market level, you're getting new supply coming in outside of that premium segment of the market. So, for example, in a market like Charlotte or Tampa, again, where there's been a ton of new supply over the last few years, you're getting a new property that's coming in at the top of its submarket in terms of average effective rent, but that submarket might be the 7th or 8th most expensive submarket in the broader region. And so these properties are coming in lower than would be the case if a new property came online in the downtown submarket or in the most expensive suburban submarket. And so what that means is because ALN calculates price class, again, at the market level, you're actually getting some new supply coming in as a Class C, for example, which would be outside the top 32% of properties in a market according to average effective rent. And so because we're seeing that unusual dynamic, because the development cycle is so long in the tooth, you're getting some unusual dynamics in the Class C space where you actually are getting some new supply, which is driving occupancy down, which is creating a headwind for rent growth. And so it's not so much the case in these Sunbelt markets where there's struggles across the board. They're struggling with poor demand in the workforce housing segments. It's that there's a ton of new units, and that still means mostly at the top of the market. So Class A and Class B are dealing with that. But it also means there's actually some new supply coming in Class C even, which is making the workforce segment behave in sort of an unusual way, again, especially in terms of occupancy performance. So that's a little bit of information there. In terms of upcoming events for me, I will be doing a webinar with Resman, which has become something of a tradition. Myself and Elizabeth Francisco at Resman have been doing usually about 2 webinars a year, just sort of taking the pulse on the market, what's going on nationally and regionally. So we'll be doing another installment of those webinars on October 11th. Check our social media for registration information on that. Also, October 16th, I will be speaking in person at the Mid-Florida Summit, and that's going to be, again, just sort of a Florida-specific look at kind of where we stand in the industry for 2024, looking ahead to 2025. And then October 29th, I'll be speaking at the Appfolio Conference in San Diego, and that's going to be a really interesting session that we're still kind of putting together, but it's going to be a little bit more interactive and looking at some data points that beyond just sort of a general high-level overview of the market. So if San Diego is a market that's relevant to you, and again, that's going to be a national purview as well. So if you're in the area, October 29th, check that out. And again, details on all of this will be on ALN's social media. And on that note, be sure to find us on your social media platform of choice. We're pretty much everywhere you are on social media, putting out great content all the time. And also our blog, alndata.com/blog. In addition to the newsletter that we send out every month, we've got additional written content that we put up on the blog as well. And with that, I will see you next month. Thank you.